The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks. This is the podcast where we dive deep into the tools, mindsets, and disciplines that give you a sharper edge in finance, business, and in life. I'm your host, Alex Savanovic, and I'm thrilled to have you with me today. Whether you're listening on your morning commute, maybe you're hitting the gym, maybe you're just chilling at home, thank you so much for carving out some time. So, quick intro for the new folks. I'm a finance grad from the Sauder School of Business at UBC, that's the University of British Columbia. And I started working at a hedge fund when I was just 19 years old, still juggling classes at the same time. I'm still with that same fund many years later, a firm that's been delivering market beating returns for nearly 3 decades. I trade across asset classes, so that's stuff like stocks, bonds, options. I think you name it, I've probably traded it. We build models to turn data into strategies, and I spend a lot of time on our private book evaluating startups and structuring some deals. I've been really lucky to get some hands on experience across every part of the business. So, trading, like I said, investing, private equity, private debt, some deal making, all of which gives me a front row seat to how money really works. And today, I'm bringing that perspective to help you navigate the often intimidating world of investing. Today, we're just going to go over some beginner stuff. But before we dive into anything today, I need to make a correction and I need to mention an important notice for the Trajecta Talks pod. First things first, I make mistakes. I do it all the time. I try not to, but we're not all perfect. Last week, during our market update on the University ROI episode, I referred to the Fed chairman as Jeremy Powell. His name, as we all know, is in fact Jerome Powell, or J Powell for short, as we've heard it before on CNBC. So I just wanted to get that out there, clear the air. I totally mispronounced that and fumbled. I apologize. Secondly, due to my absence this coming week, I'm going to be gone for about 10 days on some business for the fund that I work for. I'll be out of the country, and as such, I will not have my podcast equipment with me. We will miss 1 week of episodes. Unfortunately, this means that August 1st, there will not be an episode. However, we will resume promptly the following Friday. I believe that's August 8th, with an episode just as scheduled, right back to normal. I wish I could pump out an episode every single Friday, but life does sometimes get in the way. I do have a day job. I am a busy guy. So now that all of that is out of the way, let's dive into the market update for this week and proceed with our episode right after that. So first off, let's talk about some IPOs, initial public offerings. There was a ton of them this week, companies making their debut. The investment banking syndicates absolutely buzzing with activity this week. We were closely tracking several of these IPOs, and we are actually involved in a couple of them as well, which is super exciting. First one was NIQ Global Intelligence. So the proposed ticker for that one was NIQ. That's the market intelligence giant. The second big one that came, I believe, on the same day, Carlsmed. Proposed ticker was CARL, or Carl, as we were calling it on the desk. That's a medical device firm specializing in spinal implants. I believe both of those ones, they were the hotter ones this week, closed the books a day early, actually, ahead of the planned pricing. NIQ's book, heavily oversubscribed, reportedly 4 to 5 times its offering size. Why Carl is also seeing robust demand, oversubscribed by 2 to 3 times, particularly from specialized healthcare and some biotech funds. The general expectation is for both to see a healthy pop on the first day of trading. This should be good for syndicate and for the IPO market in general. Beyond those two, we also had MH, which is McGraw Hill. If you are like me and maybe you're fresh out of university, I know you've seen the McGraw-Hill logo on some of your textbooks. Next was ARX. That was also in the pipeline. So while their offerings are also garnering solid interest, the demand isn't quite at the fever pitch that we're seeing for NIQ or Carl. The overall activity strongly suggests, I think, that the market's appetite for IPOs remains robust. Definitely a busier week this week compared to last week. Now let's pivot over to earnings. We've had tons of earnings this week. This is where the underlying theme of market rotation is truly unfolding, at least from what I've seen. We're observing a very clear pattern beneath the surface. So, a distinct shift in capital favoring established value oriented companies, while many of the high flying momentum and growth stocks are experiencing significant pullbacks. It's sort of feeling like a classic sell the news phenomenon where news happens, stock gets hit. Uh, Sort of feels like that for numerous tech and high growth names, even when their reported results weren't overtly poor, so to speak. This suggests that market expectations for these groups and sectors may have simply become too elevated in the short term. So we've seen this play out with companies this week like NXP Semiconductor, that's NXPI, that's the ticker symbol. Philip Morris, ticker symbol on that one's PM, which both saw declines despite reporting pretty decent figures, echoing similar reactions that we witnessed from General Electric and Netflix last week. So tickers on those are GE and NFLX. This trend is only amplifying anxiety in the tech sector specifically, especially amidst reports that the highly anticipated Stargate data center initiative, that's a collaboration between OpenAI and SoftBank, is facing construction delays, which could temper some of the broader AI driven market euphoria. Conversely, we're seeing notable resilience and strength in sectors like healthcare with names such as ARE, that's Alexandria Real Estate Equities, Quest Diagnostics, that's DGX, MedPace, that's MEDP, Tenant Healthcare, THC, all trading higher post earnings. I want to put an asterisk on that. We did go over some insurers last week, UNH, Humana, that all got hit, ELV, Elevance. These are separate. The housing sector is also showing surprising strength with DR Horton, ticker on that one's DHI, also PHM, surging after their results indicated better than feared performance. Other areas of outperformance include advertising, insurance, and select financial institutions. I think Zion reported Tuesday night, acted very well. All these companies led the charge. Energy, utilities, consumer staples, basic materials, transportation stocks are also displaying positive momentum in this tape. Meanwhile, the underperforming segments are predominantly concentrated in technology and related areas. So think about AMAT, that's Applied Materials, AMD, AppLovin, ARM, Avgo, Dell, NVIDIA, Oracle, Palantir, and the list goes on forever. Um, Along with automotive, GM was definitely stumbling after their report. Pentair, PNR, RTX, another military name. Sherwin-Williams, SHW, also faced a sharp sell-off after lowering its full-year outlook. So I know I mentioned a lot of tickers there, a lot of names. Let's delve into a couple of specific corporate reports. Verizon, let's do that one first. Ticker on that's VZ, delivered a solid second quarter performance this morning. The telecommunications giant surpassed expectations on both revenue and EBITDA. That's EBITDA, earnings before interest, taxes, depreciation, and amortization for those that do not know. And notably, they nudged up the lower end of their full year guidance. While they experienced some declines in consumer wireless retail postpaid phone subscribers, their broadband net additions were absolutely robust, particularly within their fixed wireless access. That's FWA if you read it in the report, keeping them on track for their ambitious 2028 targets. Management also highlighted strategic initiatives such as a 3-year price lock program and new AI powered customer service innovations. You've definitely heard of some of these AI customer service projects, so it's nice to see that things are finally coming to fruition. Overall, this was a reassuringly stable report from a defensive sector player. As for Cleveland Cliffs, they reported yesterday, great report, traded well all day. Just from a trading standpoint, just something about these T+1 trades is super interesting. CLF is a name that doesn't typically move more than a few percent in a day. So to see it gap up 10% on the open Wednesday after their report, truly mind boggling. Beyond the earnings parade, though, a few other significant headlines caught our attention. So, first one for me, when I saw it come from one of the syndicate desks, was an offering from MSTR, that's MicroStrategy. They're moving forward with an offering of perpetual stretch preferred shares. The symbol on that is STRC, with pricing expected, it was expected Thursday night, July 24th. So, at the time of this recording, it hasn't happened yet. This type of capital raise typically suggests that a company is looking to secure funding without immediately diluting existing common shareholders, likely to support its ongoing strategy of Bitcoin accumulation. So I just want to point something out. There's been a lot of activity on the syndicate desks as it relates to these crypto treasury companies. I'm not going to give you my opinion on that. Everyone's got a different opinion on them. But do be wary. I've definitely read a couple things that are suspicious. And that, folks, brings us to the close of this week's market intel. It's been a period of intense activity, at least in earnings. So, without further ado, let's get right back to today's podcast discussion on stocks, bonds, and options, the basics, level one. So, let me ask you a question. Have you ever watched the financial news, heard terms like stock market surge, or bond yields are dropping, or bond yields are ripping, and just felt maybe overwhelmed? Or maybe you've thought about investing your own money, about growing your money beyond just saving it in a savings account at the bank, but you had no idea where to even begin. If that sounds like you, then you're in the right place by listening to this episode. Today, we're going to demystify some of the most fundamental concepts in the financial world. We're going to talk about stocks, bonds, and options, just the basics. This is not investment advice. Just like I said in the disclaimer, I just want to go through the basics, talk about some of the terminology so you can feel comfortable understanding and discussing this stuff with a professional. So, why is understanding these things important? Because whether you dream of buying a house or funding your retirement, funding your education, maybe starting a business, or simply building a more secure financial future, investing is an absolutely crucial part of that journey. Investing is about making your money work for you, potentially generating returns that outpace inflation and help you achieve your financial goals, regardless of your starting point. You don't need to be a finance expert or a math whiz to grasp any of these basics, and that's exactly what we're going to do today is go through them slowly, hopefully make you comfortable. This episode is, you can call it the level one guide. We're covering the absolute essentials. We're going to lay the groundwork, defining some key terminology in simple, straightforward, plain English. We'll break down what each of these financial securities is, why they exist, and how you, as an investor, can potentially make money from them. Think of this as your financial literacy bootcamp, level one, the fundamental building blocks. And it's pretty fitting because that's what Trajecta University aims to deliver. And that's what we aim to deliver on this podcast, Trajecta Talks. And there's also something to look forward to in the future. Since this is level one, we're also going to have a level two episode of Trajecta Talks that will dive even deeper. We'll explore more complex financial assets, more advanced strategies, and how these more advanced instruments can be used in more sophisticated ways. But for today, we're focusing on getting you comfortable with the basics. So let's just get started. So, core segment number one, we're going to talk about stocks. It's the slice of the company pie. Let's kick things off with the stocks. Like I just said, when you hear about the stock market, this is what most people are talking about. So, what exactly is a stock? At its simplest, stock represents ownership in a company. So imagine your favorite coffee shop, maybe Starbucks, or a big tech company, think maybe Apple or Google. So when you buy a share of their stock, you're essentially buying a tiny piece of that company. You become a part owner, so to speak. The more stock you buy, the larger percentage of ownership you have. So why do companies issue stocks? They do it to raise capital or raise money to fund their operations, expand their business, maybe develop some new products, or even acquire other companies. Instead of borrowing money from a bank, they can sell ownership stakes to investors. Now, how do you as an investor make money from these stocks? Well, there are primarily two ways. Number one, which you'll hear about a lot more in the news, and if you consume any financial media or on your social media, Capital appreciation. This is the most common way, like I just said. If the company performs well, grows, becomes more profitable, its stock price might go up. And if you bought a stock at $100 and sell it later for 120, that $20 difference is your capital appreciation. It's simply the increase in the value of your investment. Now, be careful depending on where you live. That $20 does get taxed. It's called a capital gains tax because of the capital appreciation that took place. The second primary way is dividends. So some companies, especially more mature and stable ones, think of companies like Coca-Cola, there's a portion of their profits, they share a portion of their profits with their shareholders. These payments are called dividends. They can be paid quarterly, annually, or on other schedules that the company decides. It's like getting a small cash bonus just for owning the stock. Not all companies pay dividends, but many of them do. So let's quickly define some essential terminology that you'll encounter when dealing with stocks. So, first off, share. We already went over this earlier. This is a single unit of ownership in a company. Public company. This is a company whose shares are traded on a stock exchange, meaning anyone can buy and sell them. So, before a company goes public, its shares are typically held privately by founders, employees, and some early investors that made investments in private rounds. Stock exchange. These are organized marketplaces where stocks are bought and sold. The most famous ones in North America are the New York Stock Exchange, that's the NYSE, and the NASDAQ. You can think of these as giant auctions where buyers and sellers meet to transact different stocks. Next up is ticker symbol. Every public company has a unique short code, usually 1 to 4 letters, that identifies its stock on an exchange. So, for example, if you've listened to our market update today or any of the other market updates, I always include the ticker after I mention the company. So, Apple is AAPL, Google is GOOGL, Microsoft MSFT. You get the point. Next up is market capitalization. You'll hear it referred to as market cap often. This is the total value of a company's outstanding shares. You calculate it by multiplying the current stock price by the total number of shares a company has issued. And that tells you how big a company is in terms of its market value. Volatility. This refers to how much a stock's price goes up and down over a period of time. So, a highly volatile stock experiences sharp price swings, while a less volatile stock has more stable prices. So, higher volatility often means higher risk, but also potentially higher reward. When you hear the term bull market, it means that stock prices in general are rising, the market's rising, and investor confidence is high. And conversely, bear market means that stock prices are generally falling, the market's falling, the tape is ugly, and investor confidence is low. So, diversification. This is a crucial concept in investing. It means not putting all your eggs in one basket. I know everyone's heard that before. So, instead of buying just one stock in just one company, you spread your investments across many different companies, industries, or asset types. This helps reduce risk. And an easy way to diversify with stocks is through stock funds or ETFs. That's short for exchange traded funds, which hold a basket of many different stocks and companies. We'll have another episode specifically about diversification and the importance of ETFs in today's market. So, to sum up stocks with a simple analogy, think of it as owning a tiny piece of your favorite coffee shop, like we said before, Starbucks, maybe ticker SBUX, or tech company, means you get to share in its successes, either through its value growing or through receiving a share of its profits via a dividend. It's about being an owner, but remember, partial owner. Now let's shift gears from ownership to lending. If stocks are about buying a piece of a company, then bonds are essentially a loan that you make to a government or a corporation. So, why do bond issuers, the government or corporations, use bonds? Just like companies issue stocks to raise capital, they also might issue bonds to borrow money for various projects, operations, or to refinance existing debt. We won't dive too deep into refinance today, but that's a topic for another episode for sure. Governments might issue bonds to build new infrastructure like roads or schools, while corporations might issue them to fund a new factory or to expand their research and development. Quick asterisks on government bonds. There are muni bonds, there are federal bonds, treasury bonds, and they vary country to country. We'll definitely have an entire episode on that in the future. So, how do you, as an investor, make money from bonds? The answer to that Interest payments or coupon payments. When you buy a bond, the issuer promises to pay you regular interest payments, usually semi annually or annually, for the duration of the loan. So, fun fact, these are often called coupon payments because historically, bonds had physical coupons that you'd clip and redeem for interest. These payments are typically fixed, which is why bonds are often referred to as fixed income securities. You've definitely heard that, and there are FI desks that just do fixed income. Next, let's talk about the principal repayment. At the end of the bond's term, which is called its maturity date, the issuer repays you the original amount that you lent them, known as the face value or par value of the bond. So you get your initial investment back plus all the regular interest payments along the way. So let's define some key bond and debt terminology. So, issuer, this is the entity borrowing the money. It could be a government, think federal, provincial, state, municipal, or a corporation. Face value or the par value, like we talked about a little bit earlier, this is the amount of the loan, the principal that is returned to the investor at maturity. Typically, bonds are issued with a face value of $1,000, though it can vary at times. Next is the coupon rate, which we also mentioned briefly earlier. This is the fixed interest rate that the issuer pays on the bond, usually expressed as a percentage of the face value. So, for example, a 5% coupon rate on a $1,000 bond would mean $50 in annual interest payments. Maturity date, this is the specific date when the loan is repaid and the bond's term ends. Bonds can have short maturities, like a few months, or very long maturities, like 30 years or more. While the coupon rate is the fixed interest rate that you get, the yield is the actual return you receive on a bond, taking into account its current market price. So, bonds can be traded on secondary markets, meaning their price can fluctuate based on interest rate changes and the issuer's credit worthiness. So, if you buy a bond for less than its face value, your yield will be higher than the coupon rate and vice versa. So, bond prices and yields move inversely. As your bond price goes up, your yield goes down, and vice versa. Fixed income security, this is another term that we mentioned earlier, describes bonds because their interest payments are typically fixed and predictable. This predictability is a key reason why investors include bonds in their portfolios. It helps to balance some of the risk and offset some of that risk from stocks and equities, for example. Government bonds. These are bonds issued by governments. So examples include treasury bonds or T bonds in the US or T bills in Canada. They are generally considered lower risk because governments are typically reliable borrowers with the power to tax or print money to pay their debts. So these are super safe investments, obviously, depending on the country, but the ones in North America are very safe. Corporate bonds, these are bonds issued by companies. They can offer higher interest rates than government bonds, but carry a little more risk. So, as a company's financial health can be less stable than a government's at times, I would definitely argue that Berkshire Hathaway might have a little more financial stability than the US government currently. The risk of a company defaulting on its debt is higher than a government, so to speak, most of the time. But like I said, I don't know if Berkshire is at any risk of defaulting. To use a simple analogy for bonds, think of yourself as being the bank for a government project or a big company. You lend them money, they pay you interest regularly, and then they pay you back the original amount at the end of the term. It's about being a lender. Last but certainly not least, probably the most complex topic we're going to cover today, a little bit more advanced, but still crucial to understand at a basic level. Let's talk options. This is our first derivative topic that we're going to cover. While stocks are about ownership and bonds are about lending, options are a little bit different. They're, like I said before, a derivative product of stocks. So, what are they? Options are contracts that give you the right, but not the obligation to buy or sell an underlying asset, like a stock, at a specific price by a specific date. I said that slowly so you could digest it all, and maybe you have to replay it again, but that's totally fine. So that little piece right there, right, not the obligation part, is really key. You pay a small fee to acquire this right. That's called the options premium. It's like buying a reservation for a future transaction, but you don't have to go through with it if you don't want to. So, why do we have options? Why do people use them? At a basic level one, people use options for two main reasons, and we can get into so many other reasons on another episode. just dedicated to options, but these are the two main things. So, number one is speculation. You might buy an option if you believe the price of an underlying asset is going to move significantly in a certain direction. So, for example, if you think a stock is going to go up a lot, you might buy a call option. That is a bet on the underlying asset going up. And vice versa. If you were to bet on an asset going down, you would buy a put option. The second big reason is hedging. This is more like insurance. You might use options to protect an existing investment from a potential price drop. So, for example, if you own a stock and are worried that it might fall, you could buy a put option or sell a call, but that's, again, we'll get to that in a later episode to protect your downside a little bit. So let's quickly break down the basic terminology for options. So, a call option, this contract gives the buyer the right to buy an underlying asset at a set price. You'd buy a call option if you believe the price of the underlying asset will go up. So, a put option, this contract gives the buyer the right to sell an underlying asset at a set price. You'd buy a put option if you believe the price of the underlying asset will go down. This underlying asset term that we keep on using, this is basically just the security that the option is based on. It's most commonly a stock, but it could also be an index, a commodity, currency. There are options for a lot of different things now. Strike price, you'll see this when you look at an option chain. This is the predetermined price at which you can buy or sell the underlying asset if you decide to exercise your option. Expiration date, this is the date by which the option must be exercised. After this date, the option typically becomes worthless. Not typically, it absolutely becomes worthless. It's not worth anything after the date because you can't exercise it. Premium, this is the cost that you pay to buy the option contract. So we use the word premium because when we use the insurance example earlier, premium, you're basically buying the insurance and you're paying a premium. It's the price you pay for the right to buy or sell the underlying asset. So you're paying for that right. And to give you a simple analogy for options, think of it like a reservation for or a down payment on a future purchase or sale, but without the commitment. You pay a small fee for the option to do something. That's your premium. If the price moves in your favor, you can exercise your right and profit. And if it doesn't, you simply let the option expire, and your maximum loss is just the premium that you paid. It's a powerful tool for hedging and speculation, like I said before, and for various other strategies, but it also carries significant risk and complexity. This was a very, very high level description that I gave of options here, which is why we're only scratching the surface today. But in a future episode, we'll dive deep and we'll talk about some of the strategies that I use at the fund and some of my colleagues have used at other funds. All right, so that was I guess, tour through the absolute basics of stocks, bonds, options. Let's quickly recap the core differences between them. I know that was a lot of information. You might have to go back and rewatch a couple things. Stocks are about ownership. Like we said, you buy a piece of a company. Bonds are about lending. You make a loan to a government or corporation. And options are about your rights. You buy the right, but not the obligation to buy or sell an asset at a set price by a specific date. Understanding these basics is the first crucial step in taking control of your financial future. It's about building foundational knowledge, empowering yourself to make informed decisions, and moving beyond simply being a saver to becoming an active investor. This isn't just about accumulating wealth. It's also about gaining financial literacy and understanding what goes on out there in the market and in the world. It's super important. It's truly a life skill. And I genuinely feel like everyone should understand this. And it's why we have Trajecta University. It's why we have this podcast. So, what should you do next with this information? I would say don't act on anything. This was not financial advice. This was just information. Start small. You don't need a huge sum of money to begin investing. Talk to someone that you trust, talk to a licensed professional. Many platforms allow you to invest with very, very little. Continue to do more research. Like I said, there wasn't enough in this podcast to help you do it all, but it was a starting point. Read reputable financial news. And if you're unsure of or have specific financial goals, seriously consider speaking with a qualified financial advisor. Just like I said earlier, they can help tailor strategies to your individual situation. They can give you some pointers. Just make sure you're not paying too much for that service. And we'll have an episode about that in the future as well. So we're just getting started. Next time on Trajecta Talks, on another episode in the future, we'll be leveling up our knowledge even further as we explore more advanced financial instruments and strategies. We'll dive into topics like mutual funds, ETFs, credit default swaps, CDOs, different real estate products, commodities, perhaps even a deeper look into the more nuanced aspects of options trading. So don't miss that. We'll have a lot more information on that one. That might even be a multi part episode because everything that I just said there will definitely take longer than 30 to 40 minutes. And before we end off this episode, let's talk about our first few submissions for the Trajecta Talks stock picking competition. So it's awesome to see the engagement and the early picks coming in. This is where we learn by doing. And boy, have we already seen some lessons unfold this week. Some of the picks from last week saw some crazy moves. So, three interesting plays that we certainly have to talk about. Two from last week, one new one being initiated this week. So Hunter's submission last week was short sell OKLO. Submitted that on Tuesday, July 15th at an approximate price of $62. For those of you unfamiliar, it's an advanced nuclear technology company based in Santa Clara, California. So a short sell, remember, is a bet that the stock price will go down. Hunter was essentially calling for a correction or a decline from that $62 entry. Now, this stock has been absolutely wild. Between last episode and this one, Oklo actually saw a massive run up, at one point hitting over $70. So talk about a volatile ride, right? But this is a great lesson. Hopefully, Hunter had his risk management in place and maybe even covered his position if it got out of hand. Maybe he had a nice stop at 63 or something like that and didn't let it get to 70. Because as of right now, at the time of this recording, Oklo is trading around 61.20. So it's effectively back to where Hunter started, showing just how quickly things can change. Now, just because it came back to 61.20 doesn't mean that it's always going to come back to 61.20. That stock could easily be at 100 now, and Hunter would have an issue. So moving along, we had Jackson's submission. This was a long circle, that CRCL. Jackson, with his submission coming in last Friday, July 11th, was at $187.40. Circle, for those who don't know, operates as a global financial technology company providing a platform network and market infrastructure for stablecoin and blockchain applications. Going long, of course, is the more traditional approach, meaning Jackson believed that Circle's stock price was definitely heading up. And Jackson, you saw some fantastic gains, my friend. Circle at one point soared to 240. I think I might have even saw 250, even higher between last episode and this recording. That's a huge move in a very short time period. This is a prime example, folks, of why it's so important to have a plan for taking some of your winners off the table. Something we talk about in trading all the time. When you see a gain like that in such a short time frame, it's often smart to lock in some profit, even if you remain bullish on the long-term outlook. We always say at Spoonbill, you don't have to lock in the entire trade. You definitely shouldn't. If you have a winner, take something off the table, but make sure you stick around. Have that trail stop in. Circle is trading around $198 now, still up from Jackson's entry, which is great. But that $240 that it was at, for those who didn't capture it, you might want to revisit some of your trading rules. So we have a new submission this week. This is coming in from Max. He says long PM. That's long Philip Morris. Max submitted this pick to go long on Philip Morris on Friday, July 18th, at a price that looks to be about $179. So Philip Morris International is, of course, a leading multinational tobacco company known for its wide range of cigarette brands and increasingly for its heated tobacco and other reduced risk products globally. So, in lieu of this episode where we talked about dividends, Max likely sees value in this established dividend paying company, perhaps betting on its consistent cash flow or its transition to some of these alternative products. Now, this is a really timely one because Philip Morris just reported earnings on Tuesday, July 22nd, and the stock, I'm sorry, Max, it got absolutely smashed on that news. So we'll see if after another week, the performance there picks up a little bit. Maybe, Max, you want to DM us and tell us that you scooped up some more stock when it got hit after the report. Challenging start for Max, but that's the market for you. It can be really unpredictable, very risky at times. These early submissions and their immediate volatility highlight the absolute craziness that we're seeing in certain sectors right now and in the tape in general, honestly. We're talking about red hot groups, advanced nuclear energy, AI, especially with its perceived ties to solving so much that's going on in our world. And of course, anything crypto related is red hot right now. Like I said before, these narratives can get sort of this frenzy like feeling, driving prices to extreme levels very quickly, just like we saw in Circle, often decoupling from immediate fundamentals. That happens all the time. It's exciting. Obviously, I love talking about it on the pod and watching it on the screens, but it also screams caution. These sectors are attracting a lot of retail investor attention, and that enthusiasm can fuel incredible price moves, both up and down, making risk management and taking profits absolutely critical. So that's it for the stock picking from listeners. Please hit us up on any of our social media accounts we mentioned or the ones listed in the comments so we can dissect your picks next episode. So that's a wrap for this episode. We covered what stocks, bonds, and options are, why they exist, how you can potentially make money from them, and the essential terminology for each one. So, the big takeaway here: investing might seem intimidating at first, but by understanding these core concepts, you're well on your way to building a sharper edge in your financial life. And even if not, just understanding these things is super important, in my opinion. So, if this episode resonated with you, hit subscribe on Spotify. And if you want to watch this episode, our YouTube channel has all full episodes from the Trajecta Talks podcast. The links are in the show notes below. And if you're curious about Trajecta's programs, all the details for that are in the show notes as well. And do me a favor, share this episode with a friend who needs it. That's how we spread this edge and help as many people as we can. Folks, thank you so much for being here. Like I said, I'm Alex Savanovic. This is Trajecta Talks. I'll see you next week. Have a very happy Friday, everyone. Take care. I'll catch you next week.